Cooler inflation data was just the tailwind stocks needed to head into rally mode here. From big caps to the Russell 2000, the bulls are in charge. In the bond market, the 10-year Treasury yield fell below 4.5% for the first time in a long time, and yields have been heading lower, we know, since early October as geopolitical risks spurred haven buying. Those risks have not disappeared. Jens Nordvig says global rates are in a peaking process, and today's moves are important, and this can extend. Jens Exante Data's founder and CEO. So Jens, obviously it's a post-CPI party. You see stocks ripping, yields falling. What do you make of these moves, Jens? Do they make sense to you, or are they overdone? What's your take?
So we've been in a multi-year upward process for yields in the bond market and in the entire yield curve, right? And we've been searching for some kind of catalyst for a turn. And today was really important because services prices start to look more well-behaved, right? We've had over the last 3-4 months a situation where goods prices looked like they were much better behaved, but now we finally have the services prices, and we don't need much more of this before the Fed is going to be substantially more relaxed. That's what they've been waiting for. So from that perspective, very, very important data today.
And then, Jens, what data are you seeing in the market itself that convinces you that maybe that is a turn, a more substantial turn, in particular in the bond market?
Well, it's not every day that we see the entire yield curve rally like 20 basis points from 2-year up to 10-year and beyond. So definitely a very big move. We've seen the dollar stage a very big move today as well. It's not often we have 2% moves in rate crosses. So this is certainly something the market is taking note of. And I think rightly so, right? Because we've had a situation where yields just moved relentlessly higher from July up until a couple of weeks ago. And real interest rates got to 2.5%. That was after a multi-year period where real interest rates in the United States were 0 or even negative, right? So this idea that 2.5% was not enough, I think, is really getting pushed back now. And I think there's a very, very good chance that we've seen the peak there. And the next move from the Fed is going to be a discussion about when is cutting appropriate. They're not going to get there tomorrow. It's going to take some time, right? But I think definitely the hawks are on the back foot here. And the doves, if we just get a little bit more data with this type of flavor, is going to start to put when do we want to cut on the table.
So Jens, if the Fed is done hiking, walk us through the impact on currencies then. You know, which currencies benefit and which don't from that decision?
Well, so today we've seen a pretty broad-based move. The dollar is weak against G10 currencies, it's weak against the dollar, it's weak against the emerging market currencies. So if we are in a situation where the lower interest rates are supporting equities, that actually tends to really be beneficial against your dollar down against everything else. It gets more tricky if we have a combination of lower interest rates, but also, weak growth signals, risk aversion. Then it is only a subset of currencies that will benefit against the dollar. The Japanese yen would be potentially at the top in that situation, gold as well, right? But so far, equities have obviously taken this very bullish, and it's something that's generating dollar weakness pretty much on a very broad basis, including against emerging market currencies.
So Jens, now as we and the market looks to next year and when the Fed might be cutting rates, of course, as our Miles Ludlam pointed out yesterday, it's going to be really important why the Fed is cutting rates. Is it going to be cutting rates because inflation has come down and stabilized? Or is it going to be cutting rates because we've entered a recession and they feel like they need to cut rates to sort of rescue us? Which camp are you in at this point? Or is there any way of really knowing at this point?
No, I think you're absolutely right. Like if it is just because inflation looks a bit better, then you can essentially trim the interest rates a little bit to make them less tight, right? So maybe go from, 5.5% to 4%. That would be that scenario. If it is a situation where the U.S. economy is entering recession and you actually really need interest rates to be easy again, we can talk about very aggressive cuts, right? We would, like most people think, like a neutral rate is in the region 2.5% to 3% nominal, right? So we have a long way to go, and those much lower rates would come into play if we have that growth dimension also turning into something that's a dovish signal. We don't really have that yet. So far, it's the inflation news that is better on its own. But I do think there's potential for the growth also to flip right. We had extraordinarily strange, I would say, strange GDP numbers in Q3 with like a 5% handle pretty much. And that is not something that is reflecting what is actually going on in the US economy. We are in a weakening process, and therefore it would not be a surprise if we see some labor market indicators start to turn weaker in the next few months.
So how do you think we're positioned through year end, right? So if today, like putting aside for a moment the weakening that we could see next year in those economic signals and employment measures, there seems to be a growing feeling that it's sort of smooth sailing in equities from here until year end. What are your various data points telling you?
Well, it's always a bit dangerous when there's a very growing feeling,
Yeah.
because then it means that's about to be priced in. But I do think in the short term, right, it is a situation where it's inflation driving it. It is bullish if it's just that. And I think it'll take some time before we see evidence that the economy is also weak on a broad basis. So I think for now, the type of market regime that we have seen playing out today is likely to be the flavor the markets will have in the next, I would say, few months. And then the real reckoning in terms of weaker growth and weakness in the labor market is probably more a story that's going to play out during 2024 than imminently in the next few weeks.
Jens, good to catch up with you. Thanks for joining us, Jens Nordvig. Appreciate it.
Thank you.